Hello, everybody, and welcome. Today, my guest is Li Huang. Li is a fund analyst from Fitch Ratings. Hello, Li.
Hi, Thomas.
Li, today we want to discuss recent developments in the Chinese asset management industry. So how has the Chinese asset management market performed since beginning of this year? How have fund inflows developed?
China is the only major mutual fund market which saw its assets growing during COVID-19. The total amount of Chinese open-end mutual funds increased significantly in the first 4 months of this year and reached its highest level of 16 trillion Chinese yuan at the end of April, which is equivalent to 2.2 trillion US dollar. In May and June, there were some outflows. However, the total amount still reached 15 trillion Chinese yuan by the end of June, an overall increase of about 15% compared with the end of last year. All asset classes, money market funds, bond funds, equity funds, and balanced funds have experienced net capital inflows. It is worth mentioning the capital movements within different asset types in the first 6 months. Due to the COVID-19 outbreak in January, heightened risk aversion led capital inflows into low-risk products like money market funds and bond funds in the first 4 months. Money market fund assets alone increased 1.5 trillion Chinese yuan from January to April. The market interest rate decline in the first 4 months also boosted bond prices and contributed to the bond fund asset growth. Chinese money market funds and bond funds grew over 20% and 30% respectively in the first 4 months 2020. As the domestic epidemic situation gradually stabilized, the interest rate picked up in May, followed by the bond market correction. As the investment sentiment improves and investor risk appetite increase, combined with the strong stock market performance, we saw net outflows from money market funds and bond funds in May and June, while equity funds and balanced funds experienced net inflows. However, money market funds still account for the majority of the market. As of the end of June, money market fund account for about 50% of Chinese mutual fund assets, bond fund 20%, balanced fund 20%, and 10% equity funds.
So what are the long-term drivers for the rising demand for mutual funds in China?
Firstly, Chinese mutual fund market is structurally different from the other global markets. Money market fund is the largest fund type in China by asset and have accounted for more than half of the country's mutual fund assets since 2015. While money market fund plays a less significant role in Western countries, where equity funds dominated the market. Money market funds tend to be less affected by market movements in periods of market stress than products with high risk, like, for example, equity funds, and can even have inflows in such periods as a result of heightened risk aversion. So the high allocation to money market funds supported the high overall retention of the fund assets in China in the first quarter. Secondly, investors became more conservative after the pandemic outbreak and moved capital to safer products like money market funds. So money market fund assets grew substantially in the first quarter, even though their yields kept decreasing to its lowest level at that time. The majority of the Chinese mutual fund investors, they are domestic investors. International investors can only access Chinese mutual funds through the so-called QFII and RQFII programs, which but account only for very small share of the domestic mutual fund market. Institutional investors and retail investors have driven Chinese mutual fund growth in almost the same shares in recent years. Institutional investors account for the majority of the assets in bond funds, while retail investors tend to be more yield-driven and account for the majority of equity and balanced fund assets. Despite the yield focus, 2/3 of the money market funds investors in China, they are retail investors.
So where's this high stake in money market funds coming from? This is an international comparison. This is not very typical investment behavior.
Yeah, let's first talk about the development of the Chinese money fund market. So the first Chinese money market fund was introduced in 2003, but the Chinese money fund market had not really developed until 2013 when Yuebao was launched. I'm sure you heard about the Yuebao. Yuebao is the first money market fund distributed by Alipay online payment platform and can be used as a cash utility, which totally changed the Chinese consumer purchase and payment habits. Retail demand triggered the rapid expansion of the Chinese money funds market since 2013. Now, China has become the second largest money fund market in the world, with assets under management of 7.6 trillion Chinese yuan at the end of June this year. Yuebao is a pure retail money market fund and has an AUM of 1.2 trillion Chinese yuan, making it one of the 10 largest money market funds worldwide.
What can international investors learn from the current changes in Chinese mutual fund industry, and where are investment opportunities opening up there?
First of all, international investors' access to Chinese domestic market is still limited. They can only buy Chinese mutual fund shares via QFII or RQFII programs. Under the QFII program, the approved qualified institutional investors are allowed to convert a certain amount of US dollar to RMB and invest in the Chinese domestic security market. Under the RQFII program, the qualified investors can set up offshore yuan-denominated funds and invest in mainland China. QFII and RQFII used to have predetermined quota on the program level and on each asset manager level. But both QFII and RQFII quota restrictions were removed in May this year by regulators in effort to accelerate liberalization of Chinese financial market. There are also other possibilities to tap Chinese security market, like Stock Connect and Bond Connect. However, international investors can only buy stocks through Stock Connect and bonds through Bond Connect, while QFII and RQFII, they provide access to a broader range of products, including funds.
So we have heard about the meaning of money market funds in China. So what other investments are important for Chinese domestic investors?
Chinese people, they don't have direct access to foreign financial assets. They need to invest through so-called QD funds, the Qualified Domestic Institutional Investor Fund, if they want exposures to international assets. In QD fund, let licensed investors participate in markets abroad with a predetermined quota. So the quota is still here. Now we don't have any quota for QFII and RQFII, but for QD we still have quota. So Chinese people, they mainly invest in domestic market. Their household financial assets have been expanding very fast at a 5-year growth rate of about 12% to total 156 trillion Chinese yuan at the end of 2019. About half of Chinese household financial assets, they are deposits. And investors, they also buy wealth management products issued by banks and insurance policies. Investments in mutual funds have been increasing very fast in recent years, more than tripled since 2014. So we expect structural characteristics like increasing household wealth and an aging population to support the longer-term growth of China's asset management industry.
So this was Li Huang, fund analyst from Fitch Ratings. Thank you very much for being with us here today, Li, and sharing your insights with us.
Thank you, Thomas, for having me here.